just to run through, I thought we could talk a bit more about your overview on the economy, where the lay of the land is, then perhaps concentrate a bit on some of the issues facing this sector, and then would encourage people to get those questions coming through on the text. I'll be able to see them coming up. I'll try and weave them in as we go, but certainly we'll leave some time at the end for questions for the Minister. This is your opportunity and chance to get that burning question to the Minister of Finance. So Grant Robertson, I'll kick it off. You talked a lot about where the economy was at. I wondered what keeps you awake at night. What are the risks to this economy that worry you the most?
I do sleep pretty well, Corin, to be honest with you. That's probably genetic more than anything else. I think those international issues do worry me because there is only so much businesses, governments in a small country like New Zealand can do. We are an open trading economy, and so we rely on the actions and activities of a lot of other people. And so, you know, the things you can't control are always the things that worry you. So what do we do in the face of that is that we try and create ourselves as the most resilient economy we can possibly be, the one that looks intergenerationally to how we can sustain our wealth in the future, because most people will know, if you think about it, we're a country of 4.8 million people. We have a disproportionately high standard of living relative to that population because of how we have managed our resources and our assets in the past. We have to keep doing that. So yeah, those issues, those international issues do concern me, but we've got to work really hard to make sure we're resilient.
Does business confidence and the surveys which have shown a clear fall in business confidence and own activity and investment intentions, how much are they worrying you?
They certainly don't keep me awake at night, but I am concerned that we've got to develop a strong relationship with the business community. It's important for any government to be on at least the same page with the business community, because that's where our wealth is generated from. And I don't think we're a million miles away. My own experience of travelling around New Zealand and speaking and talking to business and listening to the concerns is that at an overall strategic level we're on the same page. The issues that we're working on are the issues business want us to work on. Those issues around technological uptake, getting more skilled staff. Still the number one issue in any business confidence survey is access to skilled staff. Making sure we build those international connections, deal with the climate change issues. Those are the things business wants us to work on. So I accept that there will be specific policy issues and areas where we will differ, and we have to sit down together and work out how we go through that. And the Prime Minister's Business Advisory Group that she announced the other day is a way of just making that a direct link, not allowing the noise in between to stop us from actually working together on our shared goal of lifting those living standards.
Do you accept that if your goal, you've stated and you've said one of the reasons for the uncertainty in business is the transition that you're trying to make. Do you accept that the transition itself will cost the country growth? Because you're giving up on housing, you're giving up on the fuel of immigration, these sorts of things coming through to go for exports. Where does the new growth come from to compensate that?
Yeah. Look, I mean, in the long run, no, I don't accept that, but in the short run, yes, because, and we already know the Treasury's own projections are for slightly slower growth that then rises and builds over the next few years. Where it comes from is making sure we're getting in and investing in the productive part of the economy, and this is where I do my small advertisement for one of the groups in the room, but I recently was launched a partnership between Booster, the former Grosvenor Financial Services, and VicLink, who are Victoria University's research commercialisation arm. That partnership for Booster to actually go in and take on a portfolio of investment of new ideas, new productive businesses, in part using the KiwiSaver fund that they run, partly their own corporate money, that's the kind of transition we want. Now, we've got a job to do in that transition of getting the settings right. That's what the Tax Working Group review's about. That's what doing the Reserve Bank Act changes are about. But I want to see that shift to productive investment, and until we get the signals right, that'll be harder for people. And we've also got to make sure we package up what we're doing so it's attractive for investors. There's a good rate of return. But the transition to a productive economy will take some time, but that's where our strengths lie, in the innovation, in the skills, in the knowledge that we've got. We've just got to get investment alongside it.
Will you spend more if you need to boost the economy?
We're already spending significantly more than the government. Look, over each budget we will spend more, yes, that will happen. But we've got those budget responsibility rules because for any government it remains a balance between investing now and spending now and making sure we're looking after future generations' needs by keeping debt as low as we can.
Just one more on that. We talked about this the other night, you're sticking to the debt target. If you can't meet the debt target, if it looks like you can't meet it, will you have to cut spending? Will you cut spending?
Look, just as the previous government did when they faced the outflow of the global financial crisis and the earthquakes, they kept up spending on those core social needs, and so would we, because that's the situation we're in. Our budget responsibility rules give us the ability, if there is another major shock, to be able to carry on and spend. And I see one of the questions that's come in already is around how are we placed to survive another GFC. Look, we continue to have relatively low levels of debt. We continue to have healthy surpluses. They are a precondition to be able to deal with that. I read that same article as well, and it's interesting. I don't feel overall that's where we are, but clearly there are still risks within the global financial environment that could lead there. But we're in a position to manage that. And yes, we've got an absolute commitment to investing in health and housing and education and reducing child poverty. And we have, if the GFC type scenario arrived again, the ability to be more flexible.
Well, let's pick up on that, because we don't have a lot of room in terms of the Reserve Bank and its ability to cut interest rates in any way that it did during the global financial crisis. Does that worry you?
Not particularly. I mean, they've kept it at 1.75 for some time. There is therefore still theoretically some room if that was where they ended up. But the Reserve Bank governor has been clear that he's not making a signal up or down at this stage. I find in my new role it's best not to comment specifically on his decisions, lest markets move.
I'll get to these questions. There's some good ones coming. I just had one more thing that I thought might be keeping you awake, and that was Shane Jones. With some seriousness actually, because he has been having a crack at business leaders in various sectors, including the banking sector most recently. And you met with him and the governor yesterday, was it? Could you tell us about that?
Yeah, we did. Myself, Shane Jones, and David Parker met with the governor of the Reserve Bank yesterday to talk about, what, if anything, can be done around the issue of services in the regions. It's an interesting issue more broadly, drawn out from the culture and conduct work that's going on at the moment with banks and with financial services providers. I mean, the first thing to say is we're not Australia, and I haven't seen any evidence that some of the egregious things we've seen in the Australian market have happened in New Zealand. But there is a question for all of us around the social licence of banks and financial services providers, the role that these people here and the banks play in our communities, and Shane is highlighting an aspect of that. Now, there's, I think as he himself said yesterday, there is probably little the bank can do from a regulatory perspective around where a specific branch is based, but there are issues around culture and conduct and the place in our community of providers of services. And the code of conduct that we saw here was interesting in that, I'll just finish this, was interesting in that regard. But in terms of what Shane is doing, Shane is a strong and passionate advocate for the regions. I disagree with him about some of the things he said about business in recent times. I've said that publicly, but it is the reality of our system, and this question will inevitably come up around coalition governments. It is the reality of our system that there are different voices, but we have a clear strategy, we have a clear program, and people can see that.
Except that, just quickly on that issue, but why should a bank have to provide a service in the regions if it's not profitable, if there isn't the population there?
Well, like I just said, I don't, from a regulatory point of view, they aren't the decisions we make. Banks make those decisions. But banks equally draw significant profits out of New Zealand. $4 billion worth of profits, if you're talking about the big four, the Aussie banks. So at that point, they're operating in New Zealand, and they'll think about what their social licence is. That's not to say they have to put a branch here or a branch there, but it is a consideration that they operate in this market. They need to be able to play the game and play by the rules, but also understand what their customers are asking for. But no, I agree with you. We'll wait and see what Adrian comes back with, but I don't think there is a regulatory place for saying where a branch is.
We are seeing a new code of conduct from the Financial Services Council. We're seeing clearly there's some moves to try and front foot this issue. Just what is your message to the industry? Is it that you've got a number of reviews in place here? You've got your Reserve Bank review as well, along with the FMA and the conduct reviews, the insurance review. Will your government act strongly if this industry does not do what it's supposed to do?
Well, it is our job to make sure that we're protecting consumers, customers, making sure that they're getting the best deal. We're working closely with Rob and Adrian as they go through this review, and we want to make sure that at the end of it, if there are recommendations that we need to put in place, we will. We're looking closely at the Australian recommendations as well, and while, as I said before, I don't see the more egregious examples, we've always got to make sure we've got fit-for-purpose regulation and that consumers can be confident in the services that they're getting. So I welcome the cooperation of financial service providers and what has happened so far, and equally if there are recommendations, I'd welcome the cooperation in implementing them.
One of the questions that had come up was around KiwiSaver. I think you've got a review on KiwiSaver, one of the many. Would you consider going to full compulsion?
It's not on the table at the moment. I don't actually think we've necessarily got a review of KiwiSaver right now. What we're doing is we've got some legislation in the House which everyone in the room will be aware of around some of the recommendations that Diane Maxwell put up. So creating a couple more contribution rates and making sure that we make it as easy as possible for people to be in KiwiSaver. The two big questions we're now working on, and Minister Farfoy's here later today, I'm sure he'll talk in a bit more detail about this. But the two big questions we are working on is the review of default providers. Now that's a legislated review, so that's not us, which takes place next year. And that's a really important opportunity for us to take stock of that part of the market, understand what obligations we think should be on default providers, and have a look at those big issues like fees, like ethical investment, because it's the right time to do it, and make sure that we're part of improving and enhancing KiwiSaver. The second big area, and the one that I've spoken to this forum about before, is what to do with the million or so people who haven't come into KiwiSaver, who were exposed to all of the incentives and still didn't come in to KiwiSaver. And that's got to be about a more flexible approach for low-income people, looking at how we link savings to wage growth so that people can make an easy transition into the savings area, looking at those financial literacy questions that clearly still underlie a lot of the behaviours. So that piece of work we'll do alongside the default provider review next year, as well as the legislation we've got in place this year.
If you could afford it, because it's not cheap, is it? Auto enrolment was the issue that the last government considered, this sort of halfway house.
Yeah.
Is that something you could, if you could afford it?
I think it's still something we'll look at, but as I say, I really want to drill down into that group of people who aren't there, and why, even faced with all of the incentives that we had, still didn't join. And again, I've been working with Diane and others around trying to understand that. There are cultural issues involved in that, there are financial literacy issues involved in that, and then there is just the plain issue of wages and people's ability to actually see within their pay packet the capacity to save. So all of those things will be part of that discussion.
And you're still comfortable with the provision that allows for the home buyers?
Look, I think that's now become relatively entrenched, and in fact is very important now for a lot of New Zealanders. So there is no intention to change that.
All right, another question there. It says you talked a lot about low carbon emission future. Who will be the winners and losers from New Zealand's transition, and how can the investment industry play a part in this? We're seeing that at the moment, aren't we, with if you're transitioning your transport system to more public transport, motorists are losing because they're paying higher taxes for petrol.
Oh, well, motorists are winning, Corin, because they're going to get less congestion on the roads of Auckland, which will in turn unleash $1 billion worth of better productivity, which is currently being held back by that congestion. We have to work out and be sensible about the way we pay for transport infrastructure in New Zealand. One of the problems we've had is that historic underinvestment is caused by people not being prepared to front up and say, here's the plan and here's how we're paying for it. So in this city here, we've done that. There's now a $28 billion transport infrastructure plan, and yes, it's got a big focus around rail in particular, and commuter rail as well as the heavy rail corridors as well. So that big plan, that kind of big plan, I think, is an example where at the end of this we should all be able to win from it. In terms of the specific stuff around the transition, we're obviously moving away from the heavy carbon emitting industries. What we're trying to do is actually have a deliberate plan for that. And I know we copped a bit of grief around the decision about offshore drilling, but actually that's about a 30-year planned transition. We were looking for the zero carbon target in 2050, and so nobody's permits offshore change in the next 10, 20 years, but the community of Taranaki and those industries are now starting to talk about where they go. The second half of the question really interests me, which is that the investment community have a really important role in supporting investment in the new technologies. We're playing our part. We've got the Green Investment Fund, which will be kicking off shortly, which is to leverage private sector investment into those technologies. I know NZX are keen to develop more around that area as well, and we want to get alongside them too. So we think there's a huge role for the investment fund in supporting transitions to those new technologies, and there's some amazing ideas there. Yes, there will be a transition as we move away.
How much will that cost? Because I've seen some estimates suggesting that it's 11 to 22% hit to growth over that period.
Yeah, there are a range of scenarios. The Productivity Commission had their report out this week where they put a few of those up. What you've always got to factor into that is what new innovations come along as we do it. How we see this as an opportunity, not just a hit. And while there might be some transition there, and there will always be growth, and the growth may be a little slower for a period of time while we make that transition, but the more we invest in innovation, the more we invest in technology, the more chance we have to pick those growth rates back up.
It comes back to the fact that you're growing, that you are managing to keep growing the economy at 3%, because if you aren't, making those transitions is going to get a lot harder politically, isn't it? You're going to find it way harder.
Oh, we still need growth, absolutely.
But if you get that growth hit from this transition, are politicians going to lose their nerve?
Well, I certainly won't. I don't think an economy based on speculation in the housing market and adding to our population is sustainable. And that's what we have relied on for the last decade or so. John Key actually stood up and said that earlier this year. He said those things are now coming off, and they are. We are seeing immigration come off a bit. House prices increases have slowed. We need a transition to a more productive economy. And I mentioned the word complexity earlier on. We need to be looking at how we add value, and we are. That's what our R&D policy is about. It's what our skills policy is about. It's how we're using the Green Investment Fund and the Provincial Growth Fund, is to get ourselves in a position where we are lifting the value of what we do and making sure we're in the right places as the technology changes, as the climate change policies come into force. So that process of transition has the potential for greater growth rates in the future, but we do acknowledge, and it's already factored into the budget, that we're off from where we were, but we're still around
Just
the 3%.
finally on this transition issue, so where are some stakes in the ground here? When do we see markers that you've made progress on this transition? How quickly? What is a marker, for example?
Well, a marker will be as we start to see investment flowing more into the productive sector, that we see more businesses being created in new technology and clean technology areas. It's when we start to see, a move away from the investment or the speculation in housing to investment in startup companies. This is one of the really interesting things about the wellbeing budget that we're doing, Corin, is that it's not just indicators about, social goods. It's also indications about small business growth, about the number of companies who are exporting. That's when you'll start to see some of those things come through.
Let's deal with some of these questions. KiwiSaver is it investing enough in New Zealand or NZ Inc.? If not, how do you see this happening while balancing the need for diversification and risk management in portfolios?
So the answer to the first part of the question is no. The $50 billion that you're looking after, I'd like to see a lot more of in New Zealand, but I've said it on this platform 3 times now. I get that you still have to have a decent rate of return, and at the moment I don't think we're packaging things up in New Zealand sufficiently well to get that, to be able to guarantee that rate of return. And I've said this a couple of times previously publicly. I take as an example what the government can do is our development of the Golden Triangle. So as we look to develop through Auckland, Hamilton, Tauranga, look to develop the transport infrastructure, look to develop the urban infrastructure, create new communities around those transport links, how can we package up those developments in ways that they're attractive to the private sector? We're working on the special purpose vehicle type investment model that allows more private capital to come in. That's an example of where I think KiwiSaver funds could have a massive opportunity to be a part of that. I mentioned earlier on the project that I helped launch in Wellington the other day, where we try and build those better links between KiwiSaver funds and startup businesses. That's risky, and the risk profile I know is difficult for people, but it can fit within different parts of your investment strategy. So government's got a job to package it up better, but I also think the fund managers in here have got a job to do to work on where are the New Zealand opportunities. I think the people who put money into your funds want to see more of it onshore as well.
Are we going to get high-speed rail in the Golden Triangle?
Watch the space.
I mean, is it seriously something you could work towards?
We certainly want the Golden Triangle to have within, well, to be the core of it, excellent transport links, and that has to be rail. There are issues around some aspects of our rail link that we need to work on, but yes, I mean, the short answer is yes. The exact shape of that will be determined over time.
But with your investment, you're sending some mixed messages, aren't you? I mean, you won't take private-public partnerships in the schools and hospitals that need to be built, yet you will take them in roading. I mean, there some mixed messages there, and you're sending a signal to foreign investment that you don't want them in housing. There's a risk that you might scare off some investment, isn't it?
Well, there shouldn't be. I mean, the housing policy is one that's about existing residential housing. We want more investment in quality, productive investment in construction in New Zealand. We're starting to see some of that. I've been talking to investors around the world and making sure they understand that's still the place that we want them. What we don't want is people speculating in our housing market to no end, and that's what we have seen. In terms of the other investment classes, yeah, look, we've made a decision that schools and hospitals are the core responsibilities of government, and we don't want them to be exposed to some of the problems that have occurred with PPPs around the world. But we do have good models of PPPs within transport, for example, and we want to look at expanding those actually within the urban infrastructure area. And this is the work Phil Twyford's doing with his urban growth agenda, the creation of an urban development authority, actually unblocking that development and in turn making it more attractive for investment. And as I said, the special purpose vehicle type model, the Crown Infrastructure Partners are currently leading and modelling a new approach, having moved on from broadband to how do we do big urban developments. That's where the opportunity lies, I think, for us to be able to forge a really good partnership with the private sector. Because I'm told time and time again there's plenty of private capital around in New Zealand. If we get the right project, that's what we're trying to do.
There was just a question that had come up there, picking up on the KiwiSaver, on this idea of the default funds, and suggesting that could you require KiwiSaver default funds to invest in productive businesses, a la the booster, I think it was.
Yeah, it's an interesting idea. I mean, there's always a balance to be struck here. We understand that the important point is that New Zealanders are being supported to live comfortably and well in their retirement, and that requires a decent rate of return from the funds. So, you know, that remains the fundamental thing. But the idea for us is that if we get, you know, a range of funds that New Zealanders are putting their money into that have got different growth paths, but also have philosophically perhaps some different ideas, that will be a good thing. There are plenty of people out there who are looking for ethical investment funds. There are plenty of people out there who want to see money invested in New Zealand. But I appreciate the point that fundamentally this is about making sure that the money is there for people in their retirement.
You've got the tax working group coming out very shortly. Would you be open if they came back with a tax savings tax incentive?
Let's see what they come back with. I'm certainly open to listening to them around how we use the tax system to support more New Zealanders into savings. There are different models internationally about how that works. Fundamentally, what we asked the working group to do was look at that balance in the system between productive investment and speculative investment, and what the tax system can do to create better investment signals. So that's what I expect them to come back and talk to us about on. Clearly, within the capital income area, there are some obvious alternatives there, but they are also expected to come back around savings, and they know the government's view that we want more New Zealanders saving more.
Let me put it another way, because they used to, I mean, I think Bill English in the past anyway, and others in Treasury used to think New Zealand didn't have a savings problem, because presumably because of our housing assets and superannuation and these sorts of things. Do we have a savings problem?
Oh, I think we've got a culture where we still need more New Zealanders saving more. So, you know, putting it in a negative language like problem, I don't think really helps. I think that we've got an opportunity for people to, using the services of the people in this room and elsewhere, to be doing more to secure their future and to be helping to provide more of a pool of capital for New Zealanders. That's an opportunity for us. Yes, we can definitely do better. We know that we've got a big chunk of people who aren't here. But I also paused for a minute to say, I was on the plane on the way up, I was reading some of the KiwiSaver stats. You know, all the forecasts said by now we'd have about 680,000 people in KiwiSaver. And we've got 2.4 billion people. That's actually good progress. We've just got to keep pushing on and being innovative and nimble about the way we encourage more New Zealanders to save.
Just on insurance, I know this isn't technically your area, Chris Farfoy is sort of got the main minister, but the IMF obviously raised concerns about a lack of a regulatory body for New Zealand in terms of insurance. You've got the second phase of your Reserve Bank review, which I understand could look at the prudential settings. Again, what is your instinct and thinking about insurance in New Zealand? Do we need to have more governance?
Yeah, it's an interesting topic. Minister Farfoy will talk more about that tonight. I mean, he's in charge of the insurance contract review, but that's a good review, that one. And that's an important piece of work. Certainly this phase 2 of the Reserve Bank Act review is around prudential regulation, but it's more from the bank's end about what we should and shouldn't be doing. And certainly in the work that Rob and Adrian are doing around culture and conduct, we want to make sure the insurance sector is living up to the obligations that I've seen on the screen today, and you know, we'll be keeping a close eye on that. You and I are both Wellingtonians, Corin, and what's happening with insurance in our neck of the woods is a bit concerning. We are seeing people being well and truly priced out of insurance at the moment around risk ratings approaches that are going to provide a big challenge to an earthquake-prone area like us. And that concerns me. I also grew up in South Dunedin, and I know that the way insurers are looking at low-lying areas a little bit below sea level is also going to pose some big challenges. So the whole way New Zealanders think about insurance is being challenged, and yeah, we've got to keep a close eye on that. If we want people to continue to look after themselves and manage their affairs, we need products in the market that are actually affordable for people.
What can you do about the situation in Wellington? If an insurance company decides the risk is too high, it's their right to charge a higher premium.
It sure is, but we need to talk about the models that lie beneath that, the rules that they work within. And I mean, this is an area that, as you say, it's not my core responsibility, but I hear a lot about what reinsurers are saying to insurers, and I think we've got to dig into that a little bit. There's obviously then potentially places in the market for someone to come in and disrupt and say, well, actually, I do think we can create a product here that's more affordable and of better value in those regions. But in Wellington, certainly from the point of view of apartment building owners and so on, this is a really challenging environment.
Because that doesn't even take into account climate change, which presumably in the future will lead to more areas around the country becoming uninsurable.
I don't know about uninsurable, but certainly poses significant additional costs on those who want to be insured. And certainly in South Dunedin, there are some big issues there around that. But that's has to be part of a much wider plan about how we're managing the effects of climate change. And that's what we're trying to do, is actually have a plan that provides a just transition. We've established a just transitions unit to be able to help manage our way through the changes we need to make. Insurance and the way that we protect people's livelihoods will be part of that. So I guess all I'm really signalling with that is that this is an area where I think consumers have probably not quite caught up yet with the changes that are happening as people come to reinsure and change policies in areas like Wellington, Dunedin, coastal areas. They're going to be surprised. I think there's room in the market for different providers, but our job is to make sure that the rules and the conduct is of the highest standard, and that's what we're focused on.
Just finally, because we've got a couple of minutes, what makes you so confident that New Zealand doesn't have the same cultural issues in terms of the Australian banking inquiry and the issues it's raised in insurance? But I'll take one example. We have seen the Financial Markets Authority, or a couple, soft commissions, and then the issue of life insurance, the churn, where there were a couple of providers were certainly taken to task, but no names. Isn't that some evidence that there are issues?
Well, I'm not denying there may be issues. The point, and Rob Everett's here, he could just stand up and I'll say that's what makes me confident. So, we haven't seen any evidence yet. That's what I'm saying. I've seen no evidence of the kind of behaviour that we've seen in Australia.
Why do you think that is?
Partly to do with our regulatory framework, partly to do with the fact that there are different rules, that there are more opportunities for us to keep a check on it, partly to do with an irony. This might be a controversial view in the room, but one of the things I think is that the size of the Australian industry, driven in part by compulsory super, 12% contribution rates, means that there's a lot to play for. And I think for a period of time, companies played fast and loose, partly because there was so much to play for. And you can see they're going to backtrack fast from that. But I'm not complacent, and it's why we've got the FMA and the Reserve Bank doing the work they're doing. And I want to give a very clear signal that if there are recommendations that arise from that and changes needed, we'll make it.
Grant Robertson, I think that's pretty much time up for us. This is one last question out there that someone wants to whip through. I think we're pretty much done. Thank you very much for your time.
My name's Simon Hoole, and behalf of the Financial Services Committee Board and members and indeed delegates today, Minister, thank you very much for your time. You may need no introduction, but you certainly deserve our thanks. I think it's important that business and government continue to work together to improve the outcomes for New Zealanders. I think the open dialogue we have is really important and will ultimately avoid unintended consequences when fixing policy. You mentioned partnerships, and I think a strong partnership with government and regulators will ensure we continue to build a productive, sustainable and inclusive economy and ensure a more prosperous future for all. This is a significant event for the New Zealand financial services sector, so we're very pleased to have had you here to share your views in a fast and changing, ever-involving industry. We have a small gift for you. I don't know if it has to go on the register, but it's only a small gift. And please join me in thanking the Honourable Grant Robertson.